What's up, everyone? So, Disney is going through a tough time right now with their actors and their writers on strike right now. So, this strike is really catching Disney flat footed right now as they're really in massive expansion mode for their content creation for their streaming service. So, this is a pretty bad time for this to all happen as ad revenue is soft and streaming isn't profitable. So, they don't kind of have that money for this business to throw at the problem to kind of make it go away, right? So this is a tough situation for Disney, and look for this to be somewhat of a headwind for the stock, for the foreseeable future until this is solved. So, with that being said, I'll dive into what I have for today. So, what I'll be doing in today's video is going over the stock on the chart, giving a price prediction. I'll also go over the financials of the stock, and then I'll dive into how Disney's financials, how their numbers compare to the peers, and then I'll jump into some analyst ratings for the stock. So, with that being said, this is not financial advice. Let's dive right in. So, this $84 level and this $80 level is where shares has found support in the past. So this $84 level is where shares bottomed in late 2022. And then this is where this $80 level is where shares had bottomed in 2020. So this 84 to $80 seems like a pretty good buying zone just purely looking at the chart. This seems like a spot in which you could pick up some shares, a spot in which we have significant support. So, with that being said, if you're a long-term shareholder, it may make sense to dive into some shares at this level. But technically looking short term, we've moved lower off this $90 resistance level twice. So we rejected this level back in early July and just last week. And this rejection comes on the backs of bearish momentum. So we had the 50-day moving average cross below the 200-day moving average on April 12th. And that is called a death cross and signifies bearish momentum. So, moving below a major support level, which is kind of coinciding with bearish momentum, that could help push shares lower over the coming months. So be on the lookout for that. But with that being said, if you're a long-term shareholder, you like the stock, you're owning it, regardless of what any YouTuber says, this $84 to $80 buy zone undeniably is a level in which there is significant support. So if you're looking to add some shares, I would say now is a better time than it was, in February when shares were near 120 bucks, right? So definitely seems like a good time to buy some shares if you're a long-term shareholder. But not to kind of talk, not to be contradictory here, but this screen shows me the monthly average return for the stock. So we can see here in July, shares typically drop 1.1%. In August, shares typically drop 2.2%. And in September, shares are typically down 5%. So this seasonal trend is actually leaning somewhat bearish. So this is definitely something to keep your eye on here. Don't overlook this. Obviously, it's not the end all be all, but it is worth noting that the seasonality trends are in the favor of the bears. With that being said, let's take a peek at some of the financials for the company. So this is Seeking Alpha here. It puts all of these factor grades relative to the peers. So for valuation, Seeking Alpha is giving the stock a D+. I would honestly kind of disagree with that, but growth is being given a B+, profitability is being given an A. So this tells me how the stock stacks up relative to the peers and how it stacks up historically. So Disney is trading at a 26 times PE, which is well above the sector median, yes, at 14, but it is below the 5-year average for the company. So on average, the stock typically trades around 28 times PE. Right now at 26, you could consider the stock is somewhat undervalued relative to its historical valuation. But with that being said, let's take a look at the forward PE. So forward PE is at 23 times, and that is below the 5-year average of 41 times. So once again, seeing the stock trade below its historical valuations. And then PEG ratio here, price to earnings growth, basically just puts the PE relative to growth. You can see we're at a 1.06 times PEG ratio, and that is better than the sector median at 1.6 and better than the 5-year average at 3.5. So valuation can relative to growth looks pretty good as well. And then price to book ratio is at 1.6, which is below the sector median at 2.04, but is also below the 5-year average at 2.7. So net, you add it all up, price to book ratio looks pretty cheap compared to its historical valuation and the sector median. So overall valuation, I wouldn't say is kind of a knockout number, but they don't look horrible, right? These numbers don't look horrible, especially when you consider it to the 5-year averages. Historically, the stock is trading below where it typically does in terms of valuation. And then when we look at these growth numbers, so growth for the last year was 13%. Compare that to the sector median of 4%. We're definitely outperforming the general sector. And then Disney's 5-year average of 9.4%. That 5-year average for revenue growth is below that where we are currently at. So growth is definitely above where it is typically for this stock, which is definitely a good sign for shares. Revenue growth for the next 12 months is at 12%, which is above the sector median and above the 5-year average. One thing I do want to note is that I don't love the trend of this revenue growth. So revenue growth for the past 12 months was 13%. Revenue growth for the next 12 months is projected to be 12%. So this tells me that revenue growth is slowing. But when we look at the sector, revenue growth was 4.9% for the past 12 months. For the next 12 months, it's supposed to be about 5.2%. So this tells me that revenue growth for Disney is slowing as revenue growth for the entire sector is improving. So I don't love to see that trend. Obviously, it's just a couple basis points there, but still the direction is not something you would like to see. And then EPS growth year over year was 52%, which is well above the sector median of -2%. So good to see there. And then EPS diluted growth for the next 12 months is 30%, above the sector median of 5, and above that historical growth rating of 10% for EPS. So like to see all those numbers there. They look pretty positive. So good overall, good growth numbers, predominantly above the 5-year averages for the stock. So growth and valuation overall look pretty solid. And then when we take a look at profitability margins here, so the profitability grade that Seeking Alpha gives the company is an A, and the gross profit margin is 33%. That basically just tells you what the company makes on its goods and services that it sells. So that's basically revenue minus cost of goods sold. So the company makes 33% on everything that it sells. And for those that don't know, that is actually below the 5-year average and below the sector median. So profitability numbers not looking too great there. And then net income margin also coming in at 4.7%, which is below that 5-year average of 6.8% and above that sector median of 2.8. So overall profitability numbers don't look the best here. And then cash per share is at $5.70, which makes up about 7% of the company's market cap. So that's a pretty solid number there. That definitely does allow the company to run its operations for the foreseeable future. Definitely good to see that cash on hand as well, given the current situation with the labor strike. So that is all pretty good there. And then I'll take a look at how these numbers stack up to the peers. So first, let's dive into the trading numbers. So over the past 12 months, the company has underperformed the general peers, basically trading in line to its closest peer here to Warner Brothers. So not a good sign there. You never want to dive head first into a stock that is underperforming the shares. Maybe I shouldn't say never there, but more than not, that's typically a bad sign. But let's take a look at the valuation numbers. Obviously, we went through Disney's valuation. Netflix trades at 39 times PE. Warner Brothers trades at 19. So Disney is trading above the valuations of Warner Brothers, which isn't a great sign for the stock. But obviously it's just one company, and and obviously shares are cheaper than Netflix and the other farther out peers. So, overall valuation doesn't look too shabby, but it is worth noting that Warner Brothers, its closest peer, is trading at a cheaper valuation than Disney. And then when we take a look at revenue growth, so revenue growth of 13% for Disney is basically in line with the peers. Shopify obviously above Disney, and Warner Brothers once again trading at, has a better metric here for growth at 230% growth compared to Disney's 13% growth. And then profitability is 33%. So, gross profit margin 33%, which is below Netflix, actually above Spotify, and below Warner Brothers again. So another metric here where Disney is underperforming its closest peer, Warner Brothers, which I really don't like to see. So let's keep it moving. Let's take a look at the balance sheet. So we can see that Disney has $10 billion in cash on hand compared to $48 billion in debt. So net, they have net debt of $38 billion. And then Warner Brothers has net debt of $46 billion. So they have $46 billion more in debt than cash. They only have a $2 billion cash position. So this cash balance may be leading to the lower valuations for Warner Brothers relative to Disney. The good numbers there. And then Netflix, net debt at $9 billion, and then the other peers are net debt about $1.5 billion. So overall, these numbers, Disney isn't really popping out on the page when you compare it to the peers. Although the numbers don't look horrible, and the company is trading at a good valuation relative to its own history, and good growth numbers relative to its own history. But that's just what I think. What do Wall Street investors think? So there are 16 buy ratings on the stock and 3 overweight ratings and 2 holds. So there isn't a single analyst out there on Wall Street that is willing to put a sell rating on Disney. Very interesting. And even the lowest price target is $103. So this tells me that institutional investors may be using this drop as a kind of a buying opportunity. So definitely good for the bulls to see that there's a general consensus throughout Wall Street that the stock is a massive buy at this point in time. So that is definitely great for Disney shareholders. So with all that being said, the company trades at a cheaper valuation than it typically does to its history, and better growth numbers than it typically has for its history as well. But the stock is still well above its sector median in terms of PE, which I don't like to see, which means that the stock is somewhat expensive relative to the sector. So I think there is some credence to the cautious take many investors are having on Disney right now. So personally, my personal opinion is that you should proceed with somewhat caution with Disney. I wouldn't be diving in head first until we see this media strike at least, kind of get solved, and hopefully see some profitability numbers improve. Like I said, this 33% gross profit margin is below the sector median and below the 5-year averages. So I'd want to see profitability improve, and I also want to see this writer's strike kind of subside here as a headwind for shares. But with that being said, we are at a really good support level for Disney when you look at the long-term chart. So this $84 level to $80 seems like a pretty good buying zone when you're looking at at the chart just from a technical standpoint. So with that being said, I had a ton of info in this video. I hope you enjoyed it. I will end the video there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.